Imagine a company just posted the best earnings in its entire history, yet the stock price absolutely implodes by 40%. Sounds impossible, right? Well, that's exactly what's happening with SoFi Technologies right now. I'm Smart Stock Sam, and today we're diving deep into whether this crash represents systemic contagion or the buying opportunity of a lifetime. Here's what makes this situation so fascinating. While Wall Street is having a complete meltdown over SoFi's stock price, the actual business underneath is firing on all cylinders. We're talking record-breaking performance, S&P 500 eligibility on the horizon, and growth numbers that would make most CEOs jealous. But somehow, the stock got cut nearly in half from its $33 peak, down to around $20. So what's really going on here? Is this a value trap waiting to destroy your portfolio? Or are we witnessing one of those rare moments where fear creates generational wealth? Let me paint you the full picture. On one side, you have what I call the engine. SoFi just crushed Q4 with $173 million in net income. They added 1 million new members in a single quarter during a market downturn. And they just cleared the profitability bar for S&P 500 inclusion. That's not speculation, that's math. But on the other side, you have the noise, a brutal 40% price collapse fueled by macro chaos and forced liquidations. One side is driven by fundamentals, the other by pure fear. The question is, which side wins? Let's break down those Q4 numbers because they're genuinely impressive. Adjusted net revenue hit $1.01 billion, beating Wall Street expectations by over 30 million. But here's what really caught my attention. They scaled to 1 million new members in a single quarter. Think about that for a second. In the middle of economic uncertainty, with recession fears swirling and consumers supposedly tightening their belts, people are still choosing SoFi over traditional banks at an accelerating rate. That tells you something powerful about brand strength and product market fit. And earnings per share? A massive 160% increase from the previous baseline of just 5 cents. We're watching real operating leverage kick in here. These aren't the numbers of a dying company bleeding customers. These are the numbers of a business hitting its stride and proving the skeptics wrong quarter after quarter. Now here's the catalyst that nobody's talking about. That $173 million in net income isn't just a feel-good milestone. It officially qualifies SoFi for S&P 500 inclusion based on the trailing 12-month profitability requirement. Do you understand what that means? We're potentially looking at a March 2026 institutional re-weighting event where massive index funds will be forced to buy SoFi shares. This isn't a speculative fintech story anymore. This is a profitable financial powerhouse transitioning into the big leagues. But wait, because the growth trajectory gets even better. For 2026, management is guiding toward approximately $1 billion in net income with earnings per share between 60 and 75 cents. Let me put that in perspective. This company is evolving from a growth-at-all-costs startup into a legitimate cash-generating engine. That's structural maturation happening in real time. So if the business is this strong, why did the stock crash? Here's where it gets interesting. 3 massive macro headwinds hit all at once, and none of them had anything to do with SoFi's actual business fundamentals. First, a government shutdown suspended critical economic data releases. The Bureau of Labor Statistics couldn't publish jobs reports, and CPI data was delayed. Investors were literally trading blind without the economic compass they rely on, so they retreated to cash positions. That created indiscriminate selling pressure across growth stocks. Second, the crypto market imploded, with Bitcoin retreating from 125,000 down to 75,000, wiping out roughly 500 billion in liquidity almost overnight. Even though SoFi has minimal direct crypto exposure compared to companies like Coinbase, it got hammered by guilt by association selling from algorithms and panicked retail investors. And third, disappointing forward guidance from AI chip leaders like AMD, which dropped 16%, triggered a massive sector-wide rotation out of growth multiples and into legacy cash cow dividend stocks like Apple. This was a perfect storm of external contagion, not a company-specific failure. There were no negative SEC filings, no guidance revisions, no executive departures, just pure macro chaos. So what's SoFi actually worth? This is where Wall Street is completely divided. The bear case looks at a trailing price-to-earnings ratio of 54 and screams overvalued. But here's the problem with that analysis. It's a retrospective trap. It completely ignores growth velocity. Meanwhile, major institutions like JPMorgan and Mizuho are looking forward. Based on that $1 billion income target for 2026, the forward PE drops into the mid-20s range. These aren't random analysts. These are overweight ratings with price targets as high as $38. That's an 80% upside from current levels. But then you have Bank of America's sell rating, and honestly, their reasoning is fascinating. They're essentially penalizing SoFi for choosing market share capture over short-term margin maximization. BofA wants management to slash marketing spend by $100 million per quarter to juice earnings immediately. But SoFi's strategy is to maintain discretionary growth spending and build long-term value. Think about what that really means. Legacy banks are literally mad that SoFi is successfully stealing their customers. That's not a weakness, that's a competitive advantage. Now let's talk about institutional gamesmanship, because some sketchy moves are happening behind the scenes. JPMorgan dumped 17 million shares during earnings, then issued an overweight upgrade just days later. That's a classic liquidity grab. They created selling pressure, scooped up shares at lower prices, then told everyone it's a buy. Meanwhile, SoFi's own chief risk officer, the guy who knows the company's risk profile better than anyone, used sophisticated hedging on his position rather than dumping shares. That's actually a bullish signal. He's managing downside while maintaining upside exposure. So, where's the bottom? Let me show you the technical picture, because understanding these levels could save you from catching a falling knife or missing the entry of a lifetime. We're currently testing critical support between $20 and $20.50. This is previous support that flipped to resistance, and it absolutely must hold for the bullish case to stay intact. A clean bounce here would signal that institutional buyers are stepping in. But the real opportunity zone for smart money accumulation? That's the $18.50 to $19 range. This is where you'd see heavy institutional scooping based on historical volume profile analysis. If we get one more panic flush on bad macro news, that's where the big players will aggressively build positions. And if things get truly catastrophic with a broader market collapse or recession confirmation, the absolute disaster floor is $15 to $17. Now, would I want to see it go that low? Absolutely not. But if it did, that would honestly represent a generational buying opportunity where you're getting a profitable, growing fintech at early-stage startup valuations. That's the kind of dislocation that creates life-changing returns for patient capital. The momentum indicators are screaming oversold right now. The RSI is near 20, a level that profitable growth companies rarely sustain for long. The stock is trading well below its 200-day moving average, but the deviation is extreme. And here's the key. Volume is declining. That tells us sellers are getting exhausted. The forced liquidation is running out of steam. So, what's the actual play here? If you're a short-term trader looking for a bounce, here's your checklist. The must-hold level is 1975. If that breaks, we're headed to the mid-teens. Watch February 11th for jobs data and February 13th for CPI. Those are potential volatility triggers. Don't get aggressive until you see a sustained close above the 200-day moving average and a confirmed buying spike in dark pool activity. That's your institutional re-entry signal. But if you're a long-term investor, the strategy is completely different. This is a dollar-cost averaging opportunity in the $18 to $21 range. Ignore the daily noise. Focus on the path to $1 billion in net income. Remember this crucial point. The business is fundamentally stronger at $20 today than it was at $8 just 10 months ago. The only thing that changed is market sentiment, not business quality. Before I share my final verdict, it is very important to highlight that this analysis is for educational purposes only and should not be considered financial advice. I am not a licensed financial advisor. Always conduct your own research and consult with a qualified financial professional before making any investment decisions. Stock investing involves substantial risk, including potential loss of principal. All right, here's my final verdict on the risk-reward setup, and this is where you need to be brutally honest with yourself about your investment timeline and risk tolerance. Yes, macro volatility could push this stock down to $15 if we get another market-wide panic event or a credit crisis that spooks investors. That's your realistic downside risk from current levels. But the upside potential? We're talking $50 or higher as SoFi matures into a top-tier U.S. financial institution, with S&P 500 inclusion-forcing passive index funds to buy tens of millions of shares regardless of price. Think about the multiple re-rating that happens when a stock transitions from speculative growth to established profitability. This 40% drawdown isn't business failure. It's violent multiple compression driven by forced liquidations and macro fear. The company at $20 today is objectively stronger than it was at $32 just weeks ago. Revenue is higher, profitability is proven, and the growth trajectory is validated. For investors with a 12 to 24-month time horizon who can stomach near-term volatility, you're getting an incredibly rare opportunity to buy a hyper-growth superstar at value stock multiples. This is the kind of setup where you either look back in 2 years and thank yourself for having conviction, or you watch from the sidelines and regret not acting when the opportunity was obvious. Sometimes, the best opportunities come disguised as disasters, and this might be one of those moments.